Welcome back to the deep dive. We have a massive stack of research to get through today, and I have to admit I've been really looking forward to this one. We're tackling a subject that it often feels like it belongs in a sci-fi novel. We're talking about the black box.
It does have a pretty ominous ring to it, doesn't it, the black
It
box?
really does. It conjures up this image of, a windowless room with a humming supercomputer, and some algorithm is just silently making these trillion-dollar decisions that no human really understands.
Right.
But our mission today is to demystify that. We are prying the lid open using a really definitive text on the subject, Inside the Black Box by Rishi K. Narang.
And Narang is, well, he's the perfect guide for this. He's a quant fund manager himself, and he wrote this book because he was tired of all the myths. He wants to show that quantitative trading isn't magic, it isn't voodoo, and honestly, it's not really about computers taking over.
That was my biggest surprise, actually. Reading through the source material, I went in expecting a story about robots, but the core theme here is actually about discipline.
That's it in a nutshell. Narang's central argument is that quant trading is just a systematic, really rigorous approach to investing. It's about taking human intuition, your best ideas, and translating them into a set of hard rules that a computer can then execute without getting, tired or scared or greedy.
Which is so significant because the vast majority of equity transactions now globally are automated. So even if you aren't a math whiz, if you have a retirement account, your money is swimming in a pool dominated by these algorithms.
You can't ignore the water you're swimming in. To understand modern markets, you really have to understand the mechanism that's driving them.
So let's introduce the cast of characters. Narang uses a persona to help us understand who these people actually are. We meet John, and John is, he's kind of boring.
In the best possible way.
Yeah.
When people picture Wall Street, they still have that 1980s movie scene in their head, right? The pit.
Oh, yeah.
Men screaming, buy, sell, waving tickets, sweating. That's the discretionary trader. That's relying on gut instinct in the heat of battle.
And John, the quant, is the exact opposite.
John is sitting in a quiet office. He might be reading a paper on physics or maybe coding. He's not frantically hitting buttons because he's already done all the hard work. He's like a pilot of a modern jet. The plane's flying itself based on the course he programmed. He's just watching the dials.
But we should make a distinction here because I think the word quant gets thrown around as this sort of catch-all term. The book distinguishes between what John does and what his partner, Mark, does. Mark is in high-frequency trading, HFT.
This is so crucial because the media just conflates the two all the time. HFT is a subset of quant trading, but it's a very, very specific game. Mark isn't looking for a company that's going to grow over the next year. He doesn't care if Apple builds a new iPhone.
He just cares about speed.
All about speed. He's scraping fractions of pennies. HFT is about being faster than everyone else to capitalize on these tiny market inefficiencies that might only exist for milliseconds. Their edge is pure technology, fiber optic cables, microwave towers.
Whereas John, the general quant, his edge is the strategy.
Yes. John is looking for alpha, which we'll get into in a moment, but he's looking for it over minutes or days or weeks. He's looking for patterns. He uses a computer, sure, but the computer is just the tool to execute his theory. He is selling wisdom. Mark is selling speed.
Okay, now, before we get into the mechanics of how this box works, we have to address the elephant in the room. Just because you have a fancy model doesn't mean you can't crash and burn.
Oh, absolutely not. The black box is not bulletproof. Narang is very clear about this. He contrasts two famous examples.
Yeah.
On one hand, you have Renaissance Technologies, the gold standard. Their medallion fund is, well, it's arguably the greatest money-making machine in history. They prove that if you get it right, it works.
But then you have the cautionary tale. Long-term capital management, LTCM.
The Titanic of finance. In the late 90s, these guys were rock stars. I mean, they had Nobel Prize winners on the payroll. They had these models that they thought were invincible. They really believed they had mathematically solved the market.
Hubris. It's a dangerous thing.
It is. When the Russian debt default happened in '98, the markets behaved in a way their models said was basically impossible. It was a Six Sigma event, something that shouldn't happen in the lifetime of the universe.
And it happened.
It did. And because they were so confident, they were leveraged to the hilt. They almost took down the entire global financial system.
So the lesson isn't just trust the math blindly.
No, not at all. Narang boils it down to three lessons. First is deep thought. You do your rigorous research before the market opens. You don't react.
Proactive, not reactive. I like that.
Second is risk measurement. You need to know exactly how much you can lose if the world goes crazy. And third, and this is the big one, is disciplined implementation.
The emotional firewall.
Exactly. The market is just a machine for transferring money from the impatient to the patient. Humans get scared, we get greedy. A quant system looks at the plan and says, I don't care how I feel, I'm executing the trade.
Okay, so that's the philosophy. But I want to crack the casing on this box. Narang describes a quant system not as one big brain, but as a modular engine.
All right, think of it like an assembly line. You can't just tell a computer, make money. You have to break the problem down. And he identifies 5 distinct modules that every system has to have. The alpha model, risk model, transaction cost model, portfolio construction, and finally, the execution model.
It sounds almost bureaucratic when you list it out like that. But let's go through them, because this is where the science happens. It all starts with the alpha model.
The engine. This is the sexy part. This is the forecast.
Right. Can we just clarify alpha for a second? Because finance people love their Greek letters.
Sure. Simply put, beta is the market. If you buy an S&P 500 fund and the market goes up 10%, you made 10%, you just rode the tide, that's beta.
Okay.
Alpha is the skill. Alpha is the return you generated above and beyond the market, or making money when the market is flat or down. It's your edge.
So the alpha model is the part of the code that's trying to predict the future.
Exactly. And Narang divides these into 2 main camps, theory-driven and data-driven.
The theory-driven one felt more human to me.
It is. It starts with a hypothesis. A human looks at the world and says, I have a theory about how investors behave.
Okay, give me an example. The book lists things like trend and mean reversion.
Let's take trend. This is basically Newton's first law. An object in motion stays in motion. A trend strategy just assumes that if a stock price is going up, investors get excited, more people pile in, and it will probably keep going up for a little while.
So the model is just saying buy high, sell higher.
Pretty much. Then you have mean reversion, which is the total opposite view. It assumes markets overreact. So if a stock drops 20% in the day, the model says, whoa, that's too much. Panic selling. It's going to bounce back. It sets on things returning to their average.
And most big funds run dozens of these, right? They don't just pick one.
Oh, absolutely. Hundreds sometimes. You might have a sentiment model scanning news headlines, a value model looking for cheap companies. But the key for all of these is that a human understands why the trade is happening.
Right. I'm buying because the trend is up.
Correct. Which brings us to the other camp, data-driven. And this is where it gets a little spooky.
The machine learning side of things.
Exactly. In a data-driven model, you don't start with a theory. You just feed the computer a massive data set, stock prices, weather patterns, satellite imagery of parking lots, and you just say, find a pattern.
You tell me.
And the computer might come back and say, hey, historically, every time it rains in London on a Tuesday, the price of gold goes up.
But that makes no sense.
To a human, no. But if the data says it works 99% of the time, the model will trade it. That's the danger, what the book calls spurious correlation.
A coincidence masquerading as a law.
And if you trade on that, you might make money for a bit, but eventually the coincidence stops and you lose everything. You have to work so hard to filter out that noise.
Okay, so we have our alpha model. It's made a prediction by Google. But we can't just go all in. We need a defense. This brings us to the risk model.
This is my favorite part of the book because it totally flips the script on how most people think about risk. We think risk management is just don't lose too much money. Narang says, no, it's about intentional exposure.
That's a great phrase. What does it actually mean?
It means you only want to take the specific risk you are being paid to take. So let's say your alpha model loves tech stocks. You think tech is going up, so you buy Google, you buy Microsoft.
Seems logical.
But wait, if the entire economy collapses, those stocks are going to fall. Not because they're bad companies, but because the whole market is falling. You don't want market risk. You only want your specific tech risk.
So how do you fix that? How do you isolate it?
You use the risk model to hedge. You might short sell an index like the S&P 500 against your tech stocks. So if the whole market crashes, your short position makes money and it offsets the loss on your tech stocks. You've surgically removed the market risk.
That is fascinating. It's like filtering water so you only drink the minerals you want.
And to do this, they use 2 types of models. Again, theoretical and empirical.
Here we go with the theory versus data battle again.
It's a recurring theme. A theoretical risk model uses logic. It says Google is a tech company, so it has tech risk. It groups things by known categories. It's clean.
But the map isn't the territory.
Precisely. That's where the empirical model comes in. It doesn't care about categories. It just looks at how prices actually move together. It might notice that lately, for some weird reason, Google is moving in sync with oil prices.
Which a theoretical model would never spot.
Never. But the empirical model says, I don't know why, but they're dancing together, so we need to manage that risk. It captures the messiness of reality, especially in a crisis.
So we have the engine, the alpha, telling us what to buy. We have the brakes, the risk model, keeping us safe. But there's a silent killer in the system, the transaction cost model.
This is the module that separates the pros from the amateurs. Narang drops a stat that just blew my mind. Transaction costs can eat anywhere from 20 to 50% of a quant strategy's profit.
Up to half.
Easily. And most people only think about commissions. It costs $5 to trade. That is the tip of the iceberg.
So what's the rest of the iceberg?
Two things: slippage and market impact. Slippage is timing. Your model says buy at $100. By the time your order gets to the exchange, the price is $100.05. You missed it.
And market impact.
That's when you are the problem. If you're a huge fund and you try to buy 1 million shares of a stock, your buying pressure drives the price up against you. You're waking the sleeping giant.
So you have to model that. You have to predict how much you're going to annoy the market.
You have to try. The book mentions a few ways, from simple to complex, but the gold standard is what's called a quadratic model.
Okay, what does that mean in plain English?
It just means the cost doesn't go up in a straight line, it curves upward, it explodes, because liquidity is finite. Think of trying to push a ton of water through a small pipe instantly. The pressure spikes exponentially. Same thing in the market.
So the transaction cost model basically tells the system, hey, great idea, but it's too expensive to actually do. Shrink the trade or don't do it.
Exactly. It's the reality check.
Yeah.
It tells the alpha model, you might be right, but you can't afford to be right.
This leads us to the portfolio construction model. So we have all these inputs. Alpha says buy, risk says not too much, cost says it's expensive. Who makes the final call?
The portfolio construction model is the judge. It takes all those conflicting voices and it tries to solve an optimization problem. It's building the perfect portfolio that maximizes alpha minus the risk minus the cost.
So this is where the really complex math comes in.
It can be. But honestly, sometimes simple methods work best. Some funds just use equal weighting. If the model likes 50 stocks, you just put 2% of your money in each one. Simple is often harder to break.
And finally, once the judge decides, okay, we need 50,000 shares of Apple, the execution model takes over.
The closer. Its only job is to get that order done without tipping off the market. It might chop that big order into 500 small pieces and feed them into the market over hours.
Yeah.
It's pure tactics.
It's incredible. When you break it down like that, module by module, it really strips away the mystery. It's just a series of logical steps.
It is. And that brings us right back to the central irony of the whole thing.
The human element.
Right. We've spent all this time talking about models and automation. But look at what makes up the black box. Who decided to use a trend strategy? A human. Who decided a 2% risk limit was the right number? A human. Who chose the quadratic cost model? A human.
The box is just a mirror of the creator's mind.
Exactly. The black box doesn't actually think. The intuition happened upstream during the design phase. The machine is just a tool to make sure that the human's best thinking is applied consistently every single day without emotional interference.
It's like Odysseus tying himself to the mast so he can hear the sirens without jumping into the sea. The code is the rope.
That is the perfect analogy. So many traders know what they should do, but they can't because they get scared. The quant encodes the should into the machine, and the machine enforces the discipline.
So zooming out, most of our listeners aren't going to go home and code a trading algorithm tonight.
I would not recommend it. It's a very expensive hobby to get wrong.
But is there a philosophical takeaway here? Because Narang seems to think this mindset applies way beyond finance.
I think there's a huge one. We live in an age of information overload. It's so easy to be reactive, to make decisions based on the latest headline or just how we feel this morning.
All the noise.
Right. The quant mindset is about filtering that noise. It's about deep thought, deciding your principles when you are calm. It's about risk measurement, knowing your downsides before you act. And it's about disciplined implementation, sticking to your plan even when it gets uncomfortable.
You don't need a supercomputer to apply that to your 401k or your career.
Not at all. A simple checklist is a type of algorithm. A set of personal rules is a black box for your life. It protects you from your own worst impulses.
I love that. We started out looking for magic, and what we found was a blueprint for discipline.
It turns out the secret sauce isn't math. It's consistency.
Rishi K. Narang's Inside the Black Box. A dense read, But if you want to understand the plumbing of modern finance, it is absolutely essential.
Highly recommended. It really changes how you see the numbers on the screen.
Before we sign off, I want to leave you with a thought to mull over. We've established that quants build these systems to remove emotion from money because emotion destroys returns.
Right.
But where else does emotion destroy returns in your life? Could you build a black box for your relationships? A set of coded rules for how you argue or how you forgive? Or is that the point where the quant mindset stops being a tool and starts being a trap? Can you optimize a human life, or does that defeat the purpose of living it?
That is a dangerous question. I think I need to run a risk model on that before I answer.
Fair enough. Thanks for diving in with us. We'll see you next time.